Well, good evening and welcome to this live stream event on the 5th of September 2023. Martin North from Digital Finance Analytics here. Great to have you on board, and thanks for taking some of your Tuesday evening out. I'd ask you please remember to like these shows. It's really important to get the like button pushed, so please push that button. And just before I bring Damien in, let me just remind you, as I always do, that we're not providing specific financial legal advice. It's a general conversation only. Encourage you to use the chat room, and specifically if you've got some questions, feel free to throw those in and we'll get to them. Please also bear in mind we do moderate the stream, so just bear that in mind when you choose what to say. I don't necessarily see all the conversation points, but if you want to get my attention, use that Walk the World. That'll make sure I see it. And for those watching in replay, this is as at the 5th of September 2023. I've also enabled Super Chat, so if you want to get your question top of the list, you can do that, or indeed make a contribution to what we do around here, and that's always greatly appreciated. Anyway, there's a lot to talk about today. China, our start, the US, what's going on there, the Australian economy, the RBA, loads of stuff. So let's bring Damien in and we can get going. Damien, hello.
Hey Martin, how you going?
I'm very good. How are you going?
Yeah, not too bad. Not too bad.
Funny times we live in, huh?
Yeah. Lots going on as always. But so it sounds like probably I was thinking that R-Star, I think it'd be good to have maybe a bit of a longer term chat as well. Like maybe we can sort of take a step back and just talk about, there's obviously the day-to-day stuff, which is easy to get caught up in, but the whole, why are you investing in the first place? And some of that R-Star, I think is a good, is good in terms of just that. What are you really expecting from assets in the long term?
It's a good question, particularly now, because I don't know what you think, but my perspective has been for some time that the US market's a price for perfection, despite the fact that things might be a bit wobbly. But if you go back to the start of the year, the thesis was the US would go into recession. The China post-COVID bounce will be very strong, so China will be really strong. And that would actually give a bit of a bounce to Australia. Now, here we are sort of in September time, and we've actually got a pretty strong US economy still, although I think there are some cracks below the surface, if you look at the banking sector, for example. But China's going through the floor. So, and in the meantime, the markets are saying, nothing to see here. Everything's fine. It's great.
Right. Iron ore price has been rallying. It's I know. Problems in China. That's who cares? Yes.
So where do you want to start the conversation then? Do we want to do a little bit on the RBA first, seeing as they made their announcement today?
Let's go into R-Star, and we'll do like a longer term win, and then we can drift back into some more public ones.
Yeah. All right. Well, okay. R-Star. So R-Star, it's a theory, right? It's a theory that there is a set rate of employment, unemployment, and interest rates that gives you neither growth nor a fall in momentum in the economy. That's the theoretical point of view, and there's a debate about where it is and what it is, and I've always felt that it's a completely theoretical discussion that probably doesn't necessarily mean a lot. But what do you think?
Yeah, and it's, I think the fact that you're saying, look, it's almost like there's a right interest rate somewhere out there. We just need to find what rate do we put that so that we're not we're not causing inflation or causing deflation. Makes sense. It's just that part about it's it feels very much as if everyone's wandering around in the dark room, sort of feeling things, trying to work out where it is. It is something that's very difficult to tell. There's no reason why it needs to be stationary as well. I think there's some pretty reasonable arguments in terms of saying that you go through periods of more and less technological change, and as you're going through that, then the R-Star will change in terms of what it needs to be at different points, and I think we are going through some pretty reasonable technological changes over the next little while, and there's a reasonable argument as well that I'd sort of put forward to say that we have actually been through some pretty significant technological changes for the last decade or so. It's just that they might not be ones that really show up in GDP stats and productivity stats, because maybe these are some of the ones, for as much as everyone complains about social media, it is very handy not having to write individual letters to, hundreds of people, or maybe not writing to hundreds, but, at least tens of people. And, there's the amount of connection in terms of that has been significant. Now, arguably, it's some of that's detracting from productivity, but it's stuff people want, and there's made some pretty significant inroads over the last decade. Regardless of whether it actually ends up in a GDP stat or not.
Right, and the thing about this sort of theoretical rate, right? It's almost as if central banks have the perfect machine, right? And they can finally calibrate and turn these knobs, and if we get it exactly right, oh look. There's no impact, positive or negative, on overall economic momentum. I mean, to my mind, it's a completely theoretical and relatively stupid discussion, but there's a lot of stuff being written about it. And the point, I think you've hit the nail on the head. It's going to move, right? Because this is a complex system that's got many, many different elements, locally, globally, what other economies are doing. So thinking that you can pick a number and then calibrate everything off that number, well, it might be an academic, dream, but it's actually, in reality, it's a bit of a nightmare, and I just think it's a waste of time. And of course, it's being used as an argument for saying, well, the Federal Reserve doesn't need to take the interest rate down to 2%. The target is not 2%. It'll be higher, so because that's the theoretical number. But the truth is, of course, that Jerome Powell at Jackson Hole said, no, we're still targeting 2%. So to my mind, there's a lot of noise here. I'm not sure whether it's actually really that relevant to, the real world. I don't know.
Yeah, so I'd like to start with some longer term stuff. And I've got a chart up. This stuff comes from, there's a book out called, what's it called? There's something to the optimists. Triumph for the Optimists, it's called. And Credit Suisse actually takes some of the data and updates it every year and puts it back out again. And it's 120 odd years of returns on all these different markets. And what we're lining up here, and it might be a bit difficult to see, but I'll talk you through it so you don't need to understand every single point on here. But it's looking at what are the equity returns, and what we're saying when we're saying equity returns, it's real, so above the inflation rate, and then comparing that to what you can get on bonds and what you can get on bills. And bills are going to be similar to what you can get in cash. So if you sort of look at Australia's second from the right, so at the very right we have South Africa. So South Africa and Australia both at sort of 6.5% in terms of equities over the 100 years, and that's above inflation. So if you're talking about inflation and what we're targeting for inflation now of 2.5%, then that's basically saying the best countries are going to come in with sort of 9% nominal growth, and then as you build your way back down again, so the average sort of country within that is probably closer to 5% above inflation. So that's sort of 7.5. If you add inflation to that, sort of 7.5%, I think is a pretty reasonable expectation for what you can get from equities over that longer term period. And then the dark blue lines, which are sort of sitting below that, that's your bonds, and then the very light blue is the bills. And so that's sort of basically saying, well, look for bills. And I guess why I'm using these is I'm sort of saying, well, is there an interest rate over the longer term, or where has the interest rate been over the long term relative to inflation? And really, it's sort of been somewhere around about that 1% level is about the above inflation. So if we're talking about inflation of 2.5%, or maybe in the US you're sort of targeting 1%. Then this is saying, it's well, so maybe somewhere between 1% and 2%, I guess is a better stream. So you've got 2% inflation plus somewhere between 1% and 2% of this sort of yield above that is what we've seen over the last 100 and something odd years. And there hasn't been heaps of variation in that one. The equity returns have been really volatile, but I think that idea that so we're talking about 3 to 4% interest rates is really what we can expect over the longer term. And then also the important factor, though, is that it's quite variable between countries. Having said that, some of the countries furthest on the left are some of the ones where the series got interrupted by things like the Second World War. So if you're Germany and you go through some hyperinflation and you have a war that puts a pretty big dent in your stock market, that obviously makes a big difference to some of those returns. But I don't know. I guess that's probably let me start with that as a beginning. Maybe we'll go to the questions, see whether that's leading you.
So the point there is that the interest rate regime that we saw over the last decade plus, ultra low rates, is not normal, right?
No.
That's what
you expect it to be about 1% above, at least 1% above your interest rate.
Right. Okay.
Sorry, your inflation rate.
Yeah, right. And so, not surprisingly, in recent times, we've seen bond rates, particularly in the US, move smartly higher, as in Australia. And all of that is signalling an interest rate environment which is higher. And I guess the question then is, there are consequences of that. And one of the things I come back to quite often is we've got huge amounts of debt in the world. I mean, more debt than ever, right? So, thanks to a whole bunch of different things, including central banks doing what they did and corporates doing what they did and the private sector doing what they did. So we've got the situation where there is a lot of debt in the system. We've got very high interest rates relative to that. And that's all a brake on what might be happening. So if they then say, well, hang on a moment, if we need to see unemployment rate rise a bit, and I think the RBA said 4.5% is what they're probably going to see. Is necessarily unemployment higher part of this story then as interest rates rise? In other words, are they effectively not pulling one lever but actually pulling two of the levers, and are those levers actually connected as far as perhaps they think they are?
Right, in terms of unemployment, I mean, this is a crux of it right now for Australia is that where are we really seeing inflation coming through? Is we're seeing it in house prices and rent in particular. We're seeing it in energy prices. We're starting to see it in oil, and we're probably going to keep seeing it in oil given the movement in petrol over the recent times. And then you come back and go, well, how much more unemployment do I need to have to get the oil price down? And you're like, well, it's not really affected by the Australian unemployment rate. How much do I need to get housing prices down? How much that will make a difference at some point. But the much bigger effect on that is, arguably that's actually having a negative effect because higher interest rates makes it more expensive for people to build houses, and so you don't build as many houses, and we're flooding the market with as many migrants as we can, and so so you sort of see a difficulty there. But I do agree that at a certain point you can break the housing market if you want to keep ratcheting house prices up. And then what was the other? And then energy prices, which we've connected ourselves to the world. We haven't got gas reservation, as we've spoken about on many times on here, and so we've connected ourselves to the world. We have a much higher energy prices than what we're seeing elsewhere, and so again, is unemployment going to bring that down? And I'd argue no, it's not really going to affect it. And so you need to get, unemployment would need to be very high before people are going to start saying, well, no, I'm going to stop turning the lights on in my house and I'm going to stop, heating my house. Like that's one of the last things people do. And so, so I guess where I'm coming to from that is I think there's things which interest rates do affect and then there's things when it doesn't. And I think we're in one of those parts where it's saying, and what do you do when it doesn't? Well, that's where you need government intervention. And I do think that's where, industrial policy and things to say, what are we going to do in terms of gas reservation? Are we going to let the gas companies charge as much as they want, or are we actually going to put some limits on it? In terms of houses, are we going to, while we're having a housing crisis and skyrocketing rents, are we going to flood the market with new migrants, or are we going to say, well, maybe we just hold off on a little bit and sort our housing situation out before we want to bring more people in and things like that, which, it doesn't seem as if there's too much signs that that's what we're going to do.
Well, those are grown-up discussions that we should be having, right?
Yes.
because they are critical big picture levers as how the economy could evolve. But it seems to me that those are actually debates which nobody really wants to have at a political level at the moment, right? I mean, if you look at the gas story, two elements. The strike in Western Australia means that global gas prices spiked by up to 10%. And probably will continue to go higher. That means in Australia, because we're directly exposed to those international prices because of the way that the market works, other than maybe WA, or that's an interesting debate in its own because of the reservation situation. So we know that there's an inflation surge coming there. We also know that some of the other complications through electricity and electricity prices effectively price off the gas price directly or indirectly, and so they're going to go up, right? And the other point is we've got a weaker exchange rate, and the weaker exchange rate, absolutely, and it's significantly weaker than where people were expecting it to be, has a significant impact because we would effectively then be importing inflation. So maybe some of those goods inflation, good news stories because of the base effects that we had are now dropping out. And then we've got in services inflation, because services inflation is very much linked specifically to wage growth. And I know that wage growth is weaker in Australia than in the UK or the US, but there is still a bit of a move up. But if you look at it in some service industries, wage growth is quite strong. So that is another reason why there's another inflationary force there. So you sort of look at those things and say, well, but none of those are directly linked to the interest rate lever.
Yeah, well, and I guess I'd argue in a way some of the wages one is a bit more just in terms of demand destruction at affecting the service industries. But on the same token, wage growth is really low. We want wage growth. Like I feel like there's this whole thing about saying, oh, we need to get our, we need to grow our economy, but without growing wages. And we're like, what the hell are we growing then? We're growing company profits and we're growing, I don't know, government. Government receipts or something like that. We want to grow wages. People live in this country. It's a much greater success sign that we've got wages growing at a great rate than rather we've got GDP or company profits or some other measure. It pains me every time I hear that people complaining about wages and particularly wages that are miles below inflation, and we're talking about we can't let wages get higher. It's like, well, I understand we don't want this wage price spiral, but we do want we should want higher wages. Yeah.
Well, absolutely. And of course, in real terms, if you look back the last 10 years or so, there's been no real wages growth. And in fact, for many sectors of the economy, particularly those younger, it's actually worse than that. They've gone backwards in real terms. And so the whole idea of throttling wages growth to try and tackle inflation, I agree.
We're already throttling it.
Yeah, exactly. So
throttle someone else. Yeah.
Exactly. And I guess that the chickens are coming home to roost a bit insofar that it's taken some time for the impact of higher wages to higher interest rates to hit. Wages growth has dropped back a little bit, but now we're seeing the concept of the lag, and in the RBA they were saying, well, 18 months is about the lag. So that suggests we're going to have a weaker economy rather than a stronger economy because of the interest rates that are already in the bucket, as it were.
Yes, yeah, absolutely. Long and variable lags, and
yes.
It's certainly it's hard to see how. It's easy to see scenarios where things get worse and we start seeing bankruptcies and all these things start to happen, and you get a decision. Oh, actually, we have pushed things too far. We need to reverse them, and then you're like, okay, well, now we're 12 months away from seeing the impact of anything. And chances are we will go to a pause, a longish pause before any reversal. So. Yeah.
And just two other quick things. The first is, of course, that with everything that's running at the moment, what happens in Australia is not actually in Australia's specific gift in many ways, because we are so dependent on what happens with China. We're so dependent on those other international trade relationships, and indeed the international movement of interest rates in other countries. And so I wonder to what extent the RBA really is in control of their own destiny, right? Is it more a question?
No,
we are a little cork on a mighty ocean, and what happens over there is actually going to be more significant and important than what they might do locally.
Yeah, absolutely. But I think that's I'd like to hope that given what we did over the last 2 decades, with mining booms and things like that, is we actually see a bit better policy from the RBA in terms of recognizing what they're trying to do, because I do think we went through this phase in the in the early 2000s where it was this idea was, hey, China's going to go on for the next 30 years, they're going to be growing, and so our currency will go high, and we need to make way, and let's let all these car companies go broke, and let's let our manufacturing sector go overseas, and because mining is the future, and China's going to grow. We're going to grab onto their coattails and ride it through, and we've seen very clearly that helps if you're an iron ore miner, but for the average person in the street, it doesn't. And that you let manufacturers and things like that go broke or leave the country because currency reaches so high, because that's what you felt you needed to do to try and fix the situation, is that they don't come back when the currency falls. Like it needs to fall significantly and stay down for a long time before manufacturers and other people will decide, yes, okay, now it is worth setting up in Australia again and bring those back. And so, I think there's, I think there's a bit of an issue for many countries, not just Australia, but this idea that we've created these independent central banks, and so therefore we can blame anything that goes wrong on the central bank. And I think we saw that in the UK, where they had these initial policies that sorry, I've forgotten the name of your temporary prime minister there for a minute. Theresa. So she was in for a short period, but where the idea was that we're going to give all these tax cuts and all that type of stuff. And I think the political view was, well, if it goes right, we'll claim benefit for it, and if it goes wrong, we'll just blame the central bank. And I think there's we need to recognise that governments and central banks need to work together. Like not every inflation problem is solved by jacking interest rates. Sometimes you need to change government policy. And I think there's far too little of that being done in many Western countries. And it seems it's easy to blame the central bank if anything goes wrong.
Absolutely. I should explain that the dogs went off. Somebody decided to make a lot of noise outside. I've got the window open because it's quite warm here today with the with the summer temperatures come back, right? So, but that means that the dog and Liz Truss was the PM, yes, the temporary prime minister, who drove the bond rates through the roof because she was going to borrow a lot without actually necessarily covering the cost of it, and that was a problem. One other factor, of course, in all of this mix is the tax take in Australia is really interesting, right? If you look at the long-term trends in tax takes, we've had more and more of it from ordinary income tax. So the proportion of income tax that people are paying today is higher than I think it's pretty much ever been. And the proportion of corporate tax taken is continuing to drop. So that's another distortion that's been created by, many years of poor policy. And another example of you can't solve this conundrum without actually thinking about that too. Yeah,
that's right. I mean, I have long discussions with my kids about these because they talk about a lot of this stuff and about inherent unfairness and stuff like that for teenagers and young 20s. Is that the problem with high income taxes is because income taxes are generally one of the easiest ones for rich people to get around. Every time we do a tax review, we talk about putting more property taxes because the reality is if you've got lots of money and you've got good accountants and you can sort of go, I started with $1 million and then went over here and went over there and went over there and it came back and visited the Bahamas and sorry, it's all gone. Sorry, I don't have to pay any tax on it. Whereas you can't do that with a house. You're like, okay, I live in this $10 million mansion or whatever. Here's my property bill tax. You can't sort of, look over there and look over there and look over there and no, sorry, all of a sudden I don't have to pay it. There's like, well, the house is still there. Somebody has to pay it. I don't care who owns it, and I don't care you've got an elaborate shell. Somebody has to pay the thing, and so that's why rich people hate it because you can't get around it. and this what you're saying about the property about income is that more and more falls upon middle income workers, because that's where they're the people who don't have the expensive accountants and can't find it much harder to shift it offshore. So every time we do a tax review, they say, yeah, we should have more property taxes because they're really easy to collect and you get lots of money from them. And then every government goes, that sounds hard, I'll leave that for somebody else. And so on to the next one and rinse and recycle. So I think Australia could definitely do with a dose of that. It's also I'm always fascinated with these changes is that do you need to do a big bang approach, or do you this whole thing of saying GST, let's make it, maybe the GST should be 20%, but who knows? Higher GST, lower taxes, lower income tax probably makes a bit of sense. But does it need to be 20% tomorrow? Do we need to go bang, or do we just do you just say, oh well, let's start moving it. Let's start moving 0.5% per year or 1% a year per year, and you know what? If we don't like it after a few years, we can stop. It's not going to Going from 10% to 11% to 12%, I feel like is a much easier task for people, and a much but every time talked about, it's like saying, well, let's move it to 20%, and everyone sort of goes, well, do I want to pay 10% more for things? So
and I just one little thought there. There's 20% VAT in the UK, right? They put it up some time ago. But even that, if I've just looked over my expenses in the UK relative to Australia, and I can tell you that I'm paying each week less for my weekly shopping relative to Australia. So, right. It's fascinating. Even taking the exchange rate and everything into account, I'm paying less now. I'm paying less for my car insurance than I did in Australia, right? Which is interesting, right? I'm actually paying less for my power bills in the UK than I was in Australia. Now, I know that in Australia things have gone even worse, right? So, but on so many fronts, I always had the view that Australia was a relatively, quote, cheap place to live. But actually, that was true when I first went there 25, 30 years ago. But things have changed now. And in fact, on so many fronts, the average bill in Australia is higher, despite the low GST, than in the UK, where there's 20% GST equivalent. I found that absolutely amazing and quite fascinating.
And oligopolies, I suspect, have a reasonable part to play. It's whenever we're looking at companies, that's a good investment. If I can find companies that have monopolies or oligopolies, then absolutely we want to invest in them. That's they're much better. You hold on to your profits a lot more easily. You usually don't have as much competition. You don't have to worry about companies engage in advertising competition. They don't worry about price competition. Whereas when you get enough companies there, then they do. Somebody or somewhere will decide, hey, you know what? I'm gonna pick up market share. And so and the car companies are a great example of that, where for years car companies struggled with low margins, and they all went through this COVID, and they couldn't build as many cars as people wanted them to, and the car companies made great profits. All of a sudden they didn't have to. I used to build 5 million cars a year. Now I'm only building 4 million cars a year, but because everyone's only building a few and the demand's really high, I put my prices up and I'm making way more money than I did. And they're all talking about how disciplined they were going to be, and they're like, "Oh, we're not going to let things go back to the bad old days." And now we've got China trying to flood the market with EVs, with cheap EVs, and the amount they're exporting is skyrocketing. And so I've no doubt that they'll come back in, and that's the benefit of competition. You have enough companies, there'll be some company out there that says, "No, you know what? I'm only the small guy. I want to be the big guy, and so I'll go with cheaper prices and force them down." Whereas when you've only got 2 or 3 players, they can. It's a lot more. The competition is a lot more gentlemanly.
Indeed. Okay, so against that backcloth, what are the implications of all of this? I'm thinking of things like, long-term commodity trends, stock market trends. How do these things flow, and does this actually then inform us as to where to and where not to think about investing? And going back to your question right at the top of the show, what is investing for, and what are the types of modes of operation around investing. Because what that we've been talking about suggests that the Australian story is not going to be very certain over the next 3 to 5 years, probably.
Yeah, well, I do want us to come back to commodities, because that's one part. And I've got a chart up just showing from that same report, and just showing the 120 years of commodities, because I keep hearing this stuff, and I think it's Goldman's who's been out pushing the story for the last few years, and you see it from a lot of different brokers, is the whole idea that the only thing that can save you from inflation is commodities. Now, put aside, the performance of a lot of these commodities, like they were telling you, the only thing that could save you from inflation was commodities when oil was $120, and now it's two-thirds of that. And so, after visiting, probably, pretty close to half of it, if you look at the sort of 120 odd year return from all these different commodities, almost all of them are negative. Aluminium sort of 2% worse than inflation over that 120 odd years. Cocoa, coffee, copper, corn, you name it, they're all sort of down. Most of them are sort of down somewhere between 0 and 1% below inflation. Coal is one that has been higher. Gold is almost 1% higher, but again, even gold, if you're saying like as an investment asset, if I can get 1% above inflation, well, that's the same as you're getting from bank accounts basically over that same period. So you look through that, and I guess that what I'm saying with all this is commodities aren't there to save you from inflation. We had a period in the 70s and 80s where we actually did have commodities were really helpful, but a lot of that was oil, and a lot of that was oil was the thing causing inflation. So yes, of course, oil did well when the thing causing inflation, it was generating it was generating good market returns, and so. Okay, so that's commodities generally. The next part then you look at for commodities is, okay, commodity futures are not the same as the physical commodities. So commodity futures are generally, the way I like to think about it is it's an insurance product effectively, is that and it's usually the producer. Sometimes it's the people buying it, but usually it's a producer who's saying, okay, I'm producing whatever wheat, and I want to make sure that I don't go broke, and so I'll hedge at whatever X $100 per ton, so that I'll do half my harvest or 3/4 of my harvest, so that I don't go broke if prices happen to fall much lower than that. And then if it goes higher, I'll take the win on that. And so effectively, what you're doing is, if you're investing in commodity futures over the long term, you're getting a little bit of that insurance premium effectively paid to you. So that's those. We spoke. So cash and bonds are sort of sitting around about that similar sort of level as those commodities. Then you start getting up a little bit higher. You can get some of your corporate bonds where you're getting a higher return over time, but you're going to run into the more idiosyncratic things where corporates will go bust, and sometimes whole sectors will run into deep problems. And then at the next level, you're sort of getting your return from equities in terms of saying, okay, I'm going to take a risk on equities, and in return for that risk, I'm going to get a higher. Well, sorry, because of taking that risk, I'm going to get a higher return. Oh, sorry, and property sits in there as well. Below equities typically, if you calculate it the right way. If you exclude a lot of the things like capex and stuff like that, you can get higher, or you can get equal returns with equities. But my experience on those ones is when you dig into how they've calculated it, it tends to be the people that say property are giving you the same returns as equities tend to sort of say, well, yeah, the median price in 1900 was this, and then the median price in 2022 is this price, and look at the growth in that, and you're like, yeah, but the median price in 1900 was a 2-bedroom minus shack somewhere, and somehow it turned into a 4-bedroom with bench. And what happened in the interim? How did that? It was magic, and it doesn't. Yeah, so you don't include those. You don't include the costs. Property gives you similar returns to shares, but I think if you can then sort of knock another % or 2 off for those, and that sort of gives you your rough range of what you should expect from these assets over the long term. So that's your long term. But the most important thing is what price you're buying it at. So if I've got this asset that's going to grow at 6% per annum or 6% real, so call it, say it's equities, and we say it's going to grow at 7.5% or 8% per annum. Now, if I'm buying it when it's really expensive, I might not get that return. I might only get a 4% return over a 20-year period. If I buy it when it's really cheap, I might get a 12% return. And so you can get quite a big swing around in that, depending upon when you're buying and where you're buying and things like that. So I guess the longer term for me is, you do want to be invested in these assets, but it's very much you should be leaning into it when it's expensive and leaning away, or maybe leaning in when it's cheap and leaning away when it's expensive, to try and generate sort of better returns.
And here's a question that came in just a second ago from Jason. And Jason, thanks for the super chat. What about crypto? Is crypto considered an investment, an asset? Or is it a legitimate hedge, or is it a speculation? Now, you and I
it's not on that 100-year chart for some reason.
Funny that it wasn't around 100 years ago.
Look, very much it's a speculative asset for me, and it's there's been private money that's been around forever. So, I think that's the way to think about this, is that it's really no different from lots of other private money that's been around. Bitcoin doesn't pay you yield. When you look at the strategies that are paying yields on some of these cryptocurrencies, typically it's all about leverage and let me sidetrack for a little bit, because I think it's an interesting story. I had somebody come into my office. I'd done a podcast on Bitcoin, and they were like, we run a family office and we do all this Bitcoin strategies. We'd love to come and talk to you and come on the podcast. I'm like, I don't think he'd listen to the podcast, just to see what I was talking about. But anyway, so came in and talked to me about all these yield products and called them deposit products. And I was like, can you call it a deposit product? Isn't that like a name for a bank? And his response was, oh, no, did I say deposit? That was an accident, whatever it is. I meant a yield product. And despite the fact he used that same word a few times again. But the point was, you go into the strategies he was using, and they were basically things like buy right strategies or option overlays and things like that, with a view that you're going to give him your Bitcoin, you're going to take the risk, and you're going to earn this return. But actually, all it was doing was adding more layers of leverage and more layers of risk over the top of it. So, I think when you're looking at assets that don't have an intrinsic return, you can't actually get a yield on these assets. The things you're doing to get those yields, you probably don't want to be doing, or that if you actually see how the sausage is made, you wouldn't be quite as excited about it. So really, now you're talking about, have I got a collectible? Have I got something which effectively I think somebody else is going to want at some point in time, and some of those do go up in value. It's when I was young, I had a full set of Indiana Jones cards that my father threw away, and I don't know how much they would have been worth now, but I'm sure they would have been great. But then again, there was Beanie Babies that went through this phase and were worth lots of money, and then far less afterwards. So collectibles are very niche. You got to try and pick what you think is going to go up and what you think's don't. So I very much put Bitcoin into I'd think about it in that category as a collectible. Will other people want to buy this from me at some point? Because that's the only way I can see it's worth money in the future.
And how would you?
I'll let you give your speech.
And how would you stack that against gold, right? Because some people who say, well, gold and crypto have very similar characteristics, limited supply, blah, 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 right? And there are other people saying, no, one's a speculative, unknowable value, and the other is actually of at least certain value, even if it doesn't necessarily grow as quickly as you might expect. So gold is an insurance.
It does help in inflation. Look, I guess in the end, gold's a whole bunch of things, and that's probably the tricky part for me. Is that on one part, yes, it is a collectible, but it's been a collectible for thousands of years, 5,000 years, or pick whatever the time frame you want. And so it's probably going to keep being a collectible. People are probably still going to want it. The demand there is genuine demand for jewelry for gold. If gold price was lower, it would be a fantastic industrial metal. We already use it for a number of industrial purposes. But if the gold price was a tenth or a hundredth of what it is at the moment, there'd be lots of industrial uses you'd be able to put in, because it's great in terms of conductivity and being able to make it really thin and all those types of things. So there are genuine other uses for gold if it's not just as a collectible. And then you come back to as part of being a collectible, it is a collectible for central banks as well, and so that's and they tend to want to buy a lot of it. So that is a helpful thing at certain points in the cycle. Central banks are very much looking at creating their own bitcoins, so their own cryptocurrencies, and so that's sort of one part, I guess, is that if I know that, say, the Russian central bank is going to be out buying hundreds of tons of gold because they want to use it for transactions and they want to make sure that, they want to try and avoid it being taken by the US government, there's a bit of demand behind that I can sort of put my finger on. Whereas if we're talking about Bitcoin, do I think Russia want to accumulate a lot of Bitcoin, or would they actually prefer to create their own? I think. And China's already trying to create its own, so I do think there's that part of gold as well. And the final thing on gold as well is that it does act as a bit of a currency in terms of being the un-dollar, the un-American dollar, as they call it. So that I do think there's trading opportunities you can see within that. So yes, I don't mind gold investments at certain points, but I don't think I don't think there's a lot of magic to it, and I think it's very much a timing issue in terms of when you want to be in and when you don't.
Indeed, and I guess it shows you the asset portfolio dilemma that you've got, right? Because if you are an investor and you're looking ultimately for two things, one is you're looking for some safety in what you're investing in, potentially some positive returns rather than negative returns, and some degree of liquidity to be able to actually adjust your portfolios if you need to portfolio adjust for any reason, whatever that may be. Those seem to me to be the critical criteria of trying to determine how you build out an investment portfolio. And if you put everything into Bitcoin, highly speculative, might go up, might not go up, the risk is you could lose a lot. Whereas if you've actually got a portfolio that's perhaps more balanced across multiple different asset pools, then you've perhaps got more natural hedges and more security. But this whole concept of how you build a portfolio and how you take account of trying to protect on the downside and find some growth on the upside, I mean, that is quite a complicated process, isn't it?
Yeah, and I think as well that thought process, I should have mentioned it. That idea about why am I getting a return on this should come back to everything that every big asset class is you're saying, okay, I get that on equities, I'm taking a risk. I'm putting money into this. It's an uncertain venture. We're going to pay employees. We're going to pay the government. We're going to pay suppliers, and we're going to pay debt holders. And then as an equity holder, if there's anything left, I'm going to get that. But there might not be anything left. So I've taken that risk. And all these other people who got pretty certain returns in terms of employees, suppliers, governments, debt holders got pretty certain returns. I was the least certain, and so therefore I get a return for taking that risk. And so I go, yes, I understand that, and I understand where that comes from, and that productivity growth and profit growth and things like that will lead to it. I understand why companies, if I get a return on corporate bonds, so I'm here's a company who wants to borrow money and do it, or if I'm doing lending money to people or banks or whatever it is, I understand why those returns go up. Typically on property, what I've got two different assets. I have a land asset and I have a depreciating building asset, and typically, if especially in growing areas of growing populations, which certainly we do in Australia, the land and restricted land use, the land asset can go up in value, and that sort of offsets the fall in value of this other thing I've got on top of it, and I can earn a return on the yield. Somebody wants to live in that or run a business, and so they're going to pay me. So I understand why I'm getting money on that. Commodities, I spoke about that. People want to hedge it, and so there's this insurance premium type thing. I understand why I'm getting money. When you start getting to collectibles and things like gold or Bitcoin, there's not actually genuinely a reason why somebody needs to pay you to own that asset. So it's not generating a yield. Effectively, what you're doing is saying, I'm buying this because I think somebody else is going to buy it from me later at a higher price. And that's the difference I look at in the way I look at assets about, is there an intrinsic generating an underlying value, which I think will hold over the long term, and I can fall back on as a way to, where am I going to make money, versus am I just buying this because I think somebody else wants to buy it from me at a higher price.
Absolutely. And I guess that shows you some of the complexity below the surface, right? As you try and figure out what the right portfolio sort of strategy is, which I guess is why there are professional portfolio managers out there to try and sort of help take people through some of these quite complicated decisions. Because actually, it's not simple, it's not straightforward. And I guess the other point is, one of the things to bear in mind is this idea of compounding interest, right? And so there are some asset classes where you're helped by time in market, right? Now, I don't think that's true of gold, right? Because it doesn't make a return. But it is true of stocks and many other asset classes too. So to my mind, time in market and the magic of compounding, which I think people don't necessarily always understand, the interest on interest on interest, and just how powerful it can be over a long time.
Well, and if you think about stocks as well, from that perspective, is so we've got about I've got to get this. I'll see if I can get these numbers off the top of my head. I feel like I think I can get there. Is that so? From what we had there, we had 7.5% return, and we spoke about 2.5% of that is coming from inflation. So basically, I've got companies earning money, and I think they're going to keep track with inflation at least in terms of those profits. And so now I've got to get, where am I getting a 5% return from on these stocks? Now, 3 or 4% of it is coming from your yield. So you're picking up most of that return on a yield. In the US, okay, it might be slightly lower, but actually what they're doing with the US is that they often have quite big buybacks. And so you're getting like another 1%, say, you're getting extra growth every year because they've bought back 1% of their shares. So instead of paying that out to shareholders, they've bought back 1% of their shares. So all the other shareholders are earning 1% higher. So effectively, it's not the same. It's not exactly the same as yield, but it's pretty close in terms of how you're getting that return. Is that they are taking money out of the company and giving it to shareholders so that there's fewer shareholders, whereas a dividend, they're taking money out of the company and paying it to all the shareholders, so you got a return. So, but it doesn't leave much left for actual productivity growth and all that type of stuff. So that's actually been really low. So and so when you look at those returns, most of the return you're getting is the yield you're going to get on that security, and the fact that that's going to grow over time with inflation. And then if I can invest in some companies that grow much faster than that, they might grow at 10%. That's great. I'm going to do way better, and hopefully that'll offset ones where dividends might shrink or profits are going backwards.
Okay, right. So where do you want to take the conversation now? As there's a couple of things I want to touch on as we go forward. One is China, but are there other aspects in this portfolio discussion you want to cover off? Property, for example. Do you want to do any more there?
Yeah. So look, I think the property one. Look, it's an interesting one because when you do some of the really long-term ones in some I think there's a couple of ones like in Europe where they've got, they've had sort of, especially in recent years, more stable populations or much slower growing populations, and property doesn't look anywhere near as good. So the benefits from property though is it is more stable. Often, it is somewhere that you can get a lot more leverage in terms of versus these other ones. People are willing to lend you a lot more, so that if you're getting a 6% return on property, say, versus a 7.5% return on equities, but you can borrow a whole bunch of it at 5%, then the actual return you're getting out of that investment is much, much higher. So keeping in mind though that if your return's below that 5%, it can go the other way really quickly. So gearing never makes can never turn a bad investment good. It can make a good investment great. It can make an average investment bad. and it can turn a bad investment terrible, but it never, you can never use gearing to turn a bad investment into a good investment. So making sure you've got the timing right on that, keeping in mind that gearing part. What was the other one I was going to say on property? Oh, and with all these as well, the problem with some of these longer term graphs, I've got a chart I should have brought it along. Is if you looked at if you had two assets, and I'll have to imagine for these, and let's say they're growing at the same rate, but they're out of sync. So one of them's going up and then coming down and up and down, and the other one's out of sync and it's going down and then up and down and then up. But they're both sort of going, in the longer term, they're giving you a similar return. Is that if you look at those graphs, whichever one of those is in a bubble, is in the top of its cycle, and the other one's in a shrink, is going to look way better. And everyone's going to talk about, oh, look at this asset. Asset A's got long-term returns of 10% per annum, and asset B's only got 5% per annum, and it looks fantastic. And it's, you should be buying more and more of asset A, and that's right at the top of the bubble. And then next thing you know, they both reverse, and then you got the same story about asset B in 3 years' time about, oh, asset B's over 50 years, it's got way better than asset A, and then so whenever you're coming back to which assets have done really well over time, there's always a question about, okay, is that asset in a bubble right now? Or did it start from like a really low point? Because the starting point and the ending point makes a huge difference. So, if you've got that 7% return, but if you bought at the bottom of a crash, and now we're in this big bubble, your returns might be 10, 15% per annum. And vice versa, if you bought at the top of a bubble and then you're into a crash, you may have negative returns, and that is negative returns on your capital, and at which point you're probably making some return though from the dividends. And so keep coming back to that. What am I really expecting from companies in terms of paying those distributions, and because that's where most of my returns are going to come from in the end. So if I'm buying something on it and it's on a effectively a yield of 1% or something like that, then that's going to give me I can expect that return plus maybe some inflation, maybe some earnings growth. It's not a particularly good return. Whereas if from the start I can pick up a 5% return on something I think is going to grow, then it's a lot more attractive investment.
Absolutely, which shows you that you've got to understand where you are in the cycle, and you've got to understand what the potential trajectories might be. And I guess also you've got to understand some of the externalities, right? So, not necessarily...
And you can be wrong.
What happened in the past doesn't necessarily tell you what's going to happen in the future, right?
Yeah, and you can be wrong. As an investor, there's going to be times when you're wrong, and the main thing you want to be doing is making sure that's not going to kill your overall portfolio. Whereas if you went all in on Bitcoin and you said, yep, this is the asset for me, I'm going to buy everything, pile everything into it, you can get that very, very wrong. But and that can blow up your entire investment thesis. But the idea that you want a diversified portfolio, you want to lean into these things, but you never want to assume that you're 100% right. And that's one part. And the other part, especially for people who are younger investors, is that idea that you want to be putting money in on a regular basis, and just that you just want to be, whatever it is, 5-10% of your what you're getting, and you're just investing that all the time, and it's going up. Is when you're first starting, it actually almost doesn't matter whether you get in on what prices you're getting in. If you're saying, okay, I've got $10,000 now and I'm going to be putting $1,000 a month away, he's actually saying, well, what does it matter whether the market's overpriced or underpriced at $10,000? Because in a year's time, that's going to be half your investment. In 5 years' time, it's going to be 20% of your investment. In 10 years' time, it's going to be such a small part. It's actually more about having that savings part coming in, wherever that's going, into whatever investments. But that idea that that constant reinvestment of money is where you see sort of that growth in wealth, and deciding whether you want to tilt it into which portfolio, whether they're going to go into equities now or bonds. That sometimes that people spend far too much time worried about that first tranche and not enough worried about making sure that they've got that ongoing investment.
Right, and I suppose there's another factor as we sort of think about this, which is about you can't set and forget. So you sort of on day one you might think about an investment strategy, but things change. right? Interest rates change or personal circumstances change. So it's not sufficient to be able to say, well, I'm going to do that and just forget all about it. There's also really important continuous thought process.
Yes and no. I'll tell you the yes part is, look, I think so. I think you should be leaning into these cycles and whatever. But in a way, for some people, maybe, especially if you think you might have a tendency to overreact, and we speak to a lot of investors who are very worried at certain times and super bullish at other times, and sort of very much swing the whole pendulum. Is that sometimes you're like better saying to people like that, look, just stick it in the middle. Stick it, if you think you should be, 80% equities, 20% cash and bonds, or 70-30 or whatever it is, maybe you're better off just sticking it in there and forgetting about it and going on with your life. And there's gonna be cycles up and cycles down, but if that's going to cause great anguish to you to be trying to watch it and time it and all that type of stuff, then maybe you're better off just sticking and leaving. I personally think you're better off, if 70-30 is the right split, I'm sort of, sometimes I'll be 50-50 and other times I might be 90-10, but I'm playing around with that sort of that key band. But I know of a number of investors I can think of who are just better off doing, put it in 70-30 and don't even look at it. Come back once a year and have an assessment about, if the market's up or down, the person I give, if I'm maybe invest in index funds or at least look at the person, if I gave it to this person and the market's up 10% and they're up 9%, that's fine. Or they're up 11%, who cares? Versus actually sort of worrying too much about exactly when to get in and out.
And just final point, there's some research that I was reading quite recently that suggested that many investors end up panicking when markets start to fall, and so they actually bail out into a falling market, and that can often be the worst thing to do.
Yeah, that's right. Retail investors, I think it's about 2% per annum is what they give up on average, and from basically buying more when things are going well, and selling when things are going badly. It's really just it's a behavioral problem rather than anything else, and it happens to everyone. It's not a it's a very common thing. An example I use often, I used to work at a brokerage firm which was very big in terms of some of the coal seam gas companies, and I think there was, I'm being overly, I'm exaggerating the end effect, but I'm sure for some investors it sort of worked this way, is that, they invested in one of these coal seam gas companies, and they put, whatever, 10, 20 grand in it. And the thing got, it was a very good one. That was some of the first ones that were out there, and it went up 5 times, and, they made 50 grand out of it. And they're like, fantastic, that's great. And then another one came along and they put some more money in that. And this one was good, but not as good as the last one. And so they made whatever out of that. And every time they'd put more and more money into it. And by the end of the cycle, when all the good ones had been sold and there were just all the crap ones out there that were all trying to market themselves and push themselves up, that was when these people were like throwing, I made 5 times more money when I stuck 10 grand in. What happens if I put $500,000 into this? And all of a sudden they're blowing up all the losses or blowing up all their wins, because they're, as the companies were getting worse, they were increasing the size of the bets because of how certain they were that, what had happened before will happen again. And it's that, that sizing part is really important for people to, the fact you've had a win, markets have just gone up 20%, makes people feel like, oh, imagine if I had to put more money in it, let me do that now, which may be exactly the wrong time. Well, history says that's the wrong time of the cycle to do it. So, that's...
it's not simple,
in
folks.
A big picture sense. No, that's right. And in a big picture sense, what's interesting is there's this group called it's an S&P. They call it the SPIVA report, and it always confuses me with this one. What they do is they come out and they talk about how the average active fund underperforms, and so you should be invested in an index fund. But the part that they don't do is they say, well, the market should add up in total. The market does add up in total. The winners, there's only, if you were talking about the average return was 10%, you can't have all the active funds underneath it. All the passive funds were definitely underneath it because they got the 10% minus their fees. All the retail investors are underperforming by 2%. Like, we've got the professional investors already doing, like, there's no one left. Who's on the other side of this? And so, I guess the big picture stuff as well is that, from I guess the way I look at it is, the professional investors do make better returns generally than the market, but typically a lot of them take it all back plus more in fees. And so, making sure if you're paying a hedge fund manager 2% and 20% of their profits, that is going to very much eat into the returns you're getting. And so, it's a mixture of picking these assets and making sure you're not paying too much in fees for the returns you're getting. So that professional investors outperform. A lot of them, they will then take it all back in fees. But if you can get one that's not charging as much in fees, then you'll do better. And then if you're taking a passive investment, absolutely look for the lowest cost and ones that can tailor and all that type of stuff like that. And that's coincidentally, that's we do have the active stuff and the passive stuff. That was what we won an award for. I think we spoke about that last week. Last time we were a finalist for IMAP, and we ended up winning that award for new product design for our passive products, which is which is great as a great validation of what we're doing. And basically the idea is very much is that we want low cost, we want transparency, and we want to let you customize it so you can build it. Build your own portfolios. Start with you choose how many stocks you want in it. 25, 30, 50, 75 stocks. For all the international stuff, we can do fractional shares now, so that you can do much lower balances. And then once you've picked that base, then you can tilt it. You can say, I'll have some extra cloud computing, or I'll have some extra cybersecurity, or I want to get rid of carbon, or I want to get, do we want nuclear power in there or out of there, or whatever it is. And you suit it to your own sort of either investment bent or ethical bent, and as a tilt. And then, that's the type of portfolio that's the way I look at it, and the types of products we're trying to produce for our customers.
Right, and I guess the point there is that means that it's not one single portfolio that effectively you guys are constructing. You are enabling and facilitating people to run a continuum between effectively saying, I don't really want to manage it myself, through to you want to be more proactive and manage it yourself through transparency. Where's the pivot at the moment? Is it more towards the former or the latter in terms of the portfolios?
Sorry, you might have to ask that one again.
Yeah, so I'm thinking at one end of the spectrum, there are people who are saying, look, just look after it for me. I'm also want to set and forget, through to people who actually want to take more ownership and proactivity and do this and use that and use the tools. I'm trying to understand where the bias
where people sit.
Yeah.
Look, we find most people who come to us, and I guess I want to preface this by saying, in a way, where because we are one of the only ones that offers this much customization within it, we often get people who want to customize. So 2/3 of the people who come to us say they want to do something to the portfolio, and a lot of this doesn't make a lot of difference at a big picture sense to your portfolio. But say we've got 75 stocks in there, and you've had a parent die of lung cancer, and you're like, I don't want to make any money from smoking. I don't care if it's the best investment in the world. I just don't want to make money from tobacco companies. And so we've knocked out, one or two companies out of that 75 stock portfolio. It's really not making that much of a difference to your performance. It may well be positive difference to the performance, but you've still got a diversified portfolio, and it's sort of suited to what you're interested in. A lot of our customers will take some small tilts. We've only just put these tilts in, but so what we're finding is a lot of them will take some small tilts in terms of saying, well, actually, I would like some extra cloud computing, or I would like some people, really pro nuclear power. I'd like some nuclear power and uranium stocks within there. And other people are against them. They don't want any of them. So those little tilts, I think, are good in terms of, you want it to feel as if it's your portfolio and it's reflecting your views and not doing things that you feel are negative to. Um, so yeah, so where I was getting to there with that was saying, so I think we find a lot of people do a small amount. Some it's a very small subset of our customers who want to make broad, really big changes and really change the structure of the portfolio based on it. We do have some, but generally speaking, most people are coming to us because they're saying, no, I really just want to start with, I want to start with an ETF effectively, or like a market fund, or I want to start with our active fund, but I just want to tailor it a little bit to what my personal preferences are.
And that's the point, isn't it? You've got this continuum, and you can navigate where you want along the continuum.
Yeah, and actually, I'll give you another couple of examples, because I know you've got a lot of international ones. If you're invested in the US and you invest in PFICs, I can't remember the exact, but I'm sorry, I should have the acronym in my head. But basically, it's passive foreign companies or whatever it is. It's devastating to your tax. So you're living in the US and you've stuck your money in an ETF in Australia, and all of a sudden you're getting smashed on your tax. Is that there's ones where we've looked to put some overlays for people to take those out, or we've got partners at various firms, Ernst & Young or things like that, who are saying, well, I work in this sector, I just can't buy anything in the banking sector. That's where I'm working. I can't have any banks, or I can't have any. We've got people. A person who works, with Apple, large shareholder. Apple gives me all these shares all the time. I don't need any more Apple in my portfolio. Cut that out. And so, certainly there's lots of different things we do for people in terms of that sort of customization part, where and that's part of having that transparency and being able to see everything yourself, is like, okay, now I can tailor that into, my grandmother gave me a whole bunch of CBA shares, so I don't want any more in my portfolio. Cut that out.
Absolutely. Well, let's just move the conversation on slightly, because last time we did a deep dive on China. I don't want to replay all of that, but things have moved on, right? So we've had a whole series of initiatives from the Chinese authorities, so cutting interest rates, redefining what a first-time buyer is and what their interest rate is. But I don't know what you think.
Law.
Yeah. The net effect of all of this potentially is a series of smaller initiatives. So it's not like the 2008 global financial crisis, but in the context of deflation, in the context of the yuan moving, significantly adverse, suggests that there are some troubling signs now. And the question is, to what extent are the Chinese government officials really wanting to stop this, or is it about a managed revaluation, and is it a managed restaging of the economy, in the knowledge that a third plus of the economy is actually all to do with property, and we've got things like Country Garden, and we've got a couple of other players looking pretty wobbly. I mean, that there's a bunch of questions, right, that's flowered.
There is a whole bunch. Yeah, that's right. Okay, let me just see if I can get this in an order that makes sense. I think so we've obviously had this wave of bad news coming out over the last month. So basically, since I talked to you, it seems as if every time you turn around, there's another stat coming out of China that's just saying how much worse, whatever it is, property, exports, consumer spending, deflation instead of inflation. Everything's sort of been all on one side of the boat. On the flip side, we have had them come out and announce a lot of stuff. To me, none of the stuff they announced has moved the needle. I think in a big picture sense, I look at this and I see a country that has built more than any country has ever built as a percentage of GDP, or has been spending more than any company has ever spent in terms of GDP on both infrastructure and property construction. And it doesn't really want to do that anymore. It is still doing it on the infrastructure side. It's still spending 20% of GDP on infrastructure. Most countries spend 5%. It is building very much bridges to nowhere, as part of that. And I do think they want to get away from that. So they need to, the economy is made up of a couple of different parts. One part of it is CapEx. The other part is you really need households to actually get out there and spend more money. And the only way they can do that is by getting more money into the households, more income or more stability, so that they're comfortable to spend that more money. To me, it seems as if China's been doing everything but that. Like they've actually been making things worse. Like we spoke about interest rates being lower. Well, part of the problem in China was financial repression. So they kept interest rates very low, and they basically force-fed that cheap debt and lower interest rates into companies, so that companies could then go out and spend and build and create a better, create more growth. And that did work really well for 15, 20 years. But it's gone too far, and then now they're just building, as I said, the proverbial bridges to nowhere. So by lowering interest rates, basically what you're doing is you're helping these corporates who are generally the biggest borrowers in the economy, and you're punishing the households who are generally the biggest savers in the economy. We spoke about having the yuan weakening. Well, yes, in the short term, there's benefits to that in terms of employment and things like that. But again, that's doing exactly the opposite. Ideally, we want the yuan higher so that Chinese people are wealthier and they can buy more, they can import more goods, and they can and have a better standard of life. It's cost them less to buy goods from America or goods from other countries. By lowering the country, what you're doing is you're helping the corporates again. So to the corporates, you're saying, okay, you can now sell your products overseas at cheaper, so effectively, they know they need to get away from bailing out corporates and they need to help individuals, but they're not doing it. They haven't got the policies. And Xi, it seems, has a very his policy seems to be that. Or certainly the comment you get is that he figures if I give this money to consumers, they'll waste it. Whereas if I give it to a company, they might waste it, but maybe they built a bridge that we didn't need, but at least we still have the bridge, Whereas if I give it to a consumer and they spend it on whatever, going to the movies and massages and, ice cream, there's nothing left to show at the end of it. It seems to be his view. And so, so I guess that's where I'm sort of in the position is, there seems to be a lot going on. There's been a lot of announcements about small things. None of the announcements I think are going to the core of the problem. They might help sort of things in the short term, but I don't think there's any. I certainly haven't seen any longer term solutions. And the most important thing though is I haven't seen anything that's really going to help that property sector. Actually, I'll show a few charts for the. Because I popped these up. I think I might have mentioned these some of the last time I was on, but it's probably graphically is an interesting to see. So there's two property developers that are really sort of hitting the headlines, which is China Evergrande, which is the top one on this chart, every chart, and Country Garden, which might be hard to see, but it's about I don't know, the 10th one down, 7th or 8th one down. So I've got the top 10 property developers, and we're looking at their debt to enterprise value. They're not outliers. Like all the properties, they've all got this debt problem. Like they've all got way too much. I think the average, if you look at the amount of debt they have compared to the market cap, for every dollar of market cap, there's about $10 worth of debt. The US home builders that I have right at the bottom there, it's 7 cents. And they're not just like, oh, there's a rogue operator Evergrande, there's a rogue operator Country Garden. They're the same. And then you jump to inventories and say, well, how much inventories have they got? And they've all got, relative to their last year's worth of sales, like they've got 2 years worth of inventories they've still got to work through. And they've all, like, again, they're the ones that have got the problems. Like Country Garden actually looks all right on this one. It's one of the better ones. And that compares to sort of the US with about a year's worth of inventory. Then you jump to the unearned income, which is basically the prepaid properties. And again, there's like, a year and a half, they've got, 100 to 150% of sales is sitting in these properties that somebody's paid for, but they haven't yet built it. And that sort of sits a little bit at odds to that inventories number I just said. But I guess the issue here is, I'm going to build a 400 apartment building, whatever. I've pre-sold 150 of them. And, I know if I build this thing, I'm not going to be able to sell the other 250 because nobody wants it. And they can see all these ones around it that are unsold. And some of them are probably mine that are unsold. but it's this bit about how do I've already taken the money from these people to build these, and part of it's just that problem is it's a distribution problem. Ideally, I'd give one of these guys an apartment in one of my other buildings, but a lot of the time they don't want it. I've paid for a building, this is here, it's waterfront, or it's wherever it is, it's near my work or near my mum's house. I don't want your other building, 5 kilometers away. So that's a huge problem. And in the US, that just doesn't. It's just not even it's not even a thing. Like, you just don't have the prepayments. It might be a couple of percent maybe for some of those companies. And then the last one as well, which is just as worrying, is that the payables and accrued expenses, which is basically all your employees and all your suppliers who haven't been paid. Now, China Evergrande do look pretty bad on that one. They're at sort of 150%, or basically a year and a half worth of sales is still outstanding. So you're probably a year and a half, you haven't paid people for. But Country Garden looks all right. They're at sort of 50%. Well, sorry, they don't look all right. They look same as everyone else does. It's still like 6 months worth of expenses they haven't paid, and suppliers. But I guess the big thing is, this is the system. Like, if you were a property developer that didn't have 6 levels of leverage, then 3 or 4 years ago, you just, natural selection got rid of you, because you needed, not 3 or 4 years, maybe a decade ago, natural selection. Everyone else was basically on this whole, we have debt and we've got more debt and we add more debt to that and we add more debt to that. And then we get these great returns when property prices go up 10%. We've got so much debt that we get these supercharged returns. And so why would you invest in the person who's not got all these debts to it? And sorry, the other thing is, this is just the stuff we know about. So on top of that, you've got off-balance sheet things, which, look, it's very hard to tell, but every country does it. This isn't particularly a Chinese thing. This is like any country that's in a bubble, there will be off-balance sheet liabilities that, right throughout it. The Chinese ones, I think best case, you've probably got about another 25% more debt. It's probably more likely to be 50 to 100% more debt sort of sitting within these. But I guess the message is, these things are not normal companies anymore. They are effectively, in my mind, government utilities. The only reason they are alive is because the Chinese government has decided they would like to keep them alive and drip them enough debt to survive. And they're basically giving them, they've sold all these properties that they want these companies to deliver. And so, my take is, I think they'll just gradually, over time, start to fall over as they deliver the prepaid properties, or they work out wherever they're going to do, whether they're giving these people properties elsewhere or doing whatever. But as those liabilities start to come good, these things will just all start to fall over. There's actually, in any other country, they would have fallen over already.
And of course, we know that some of the debt is actually owned internationally, so the bonds.
If you're an international equity holder, you're not getting your money back. Yeah, absolutely.
Exactly right. Some of the locals might get some of it back. And
but the locals who will get it back, they'll get it back because the central governments have told the banks or whatever to roll these loans over to keep this thing alive for long enough to deliver some of the properties. Yeah. And that's,
And then the other point you were making about it's opaque, right? Because a lot of this is a combination between those entities and some of the state entities that actually are the yin and the yang. And
yes,
there's been a lot of financial engineering between the two to be able to actually keep the bubble going a bit longer.
Yeah, that's right. And one of the stats we used to see was we used to get land sales come through, and that's the part where local governments sell the land to property developers who then go and build all the buildings, and that's how the local governments were funding themselves, was through these land sales, because they don't actually collect very much tax at all. And so one of the issues there is so now everyone's been all in on this, and so now they've lost their tax revenue base. And so because the numbers are looking so dire, China stopped publishing them. And that's exactly what they did with the youth unemployment stats probably 2 weeks ago. They were sort of well over 20%, and so stopped publishing. And so and even if you look at the construction statistics, so if you look at the macro numbers, like we're missing billions of square meters of property. So I've just got a calculator. I went up on screen. So the blue line there is what China says their official starts are in terms of millions of square meters of property. And I've done that on a rolling 12-month basis. So if you look at that, it's down 50%, more than 50% in terms of those starts. But the orange line is the one where I said, but the problem with the starts is the numbers don't add up. The starts are still above completions in theory, but based on what's being reported, which would mean if starts are above completions, you should actually have a rising amount of property under construction, whereas the property under construction has been falling for the last year or so. And so if you actually said, okay, well, let's pretend the construction numbers, the completion numbers are correct, and let's pretend the number of under construction is correct. What would that mean? And that's the orange line. What would that mean the implied level of starts are? And that would basically mean you could knock another half off the official rate for starts. But it's been that way for years, and it's we're literally talking about billions of square meters of missing property, where it's just like somebody said they started something and it's just not there. The other thing though is that if that grey line, which is the amount under construction, if you look at that versus completions, that sort of says it's going to take 9 years to complete the stuff that's currently there. Now, there's lots of problems with the Chinese building sector, but building slow isn't one of them. Like, they build these things quick. Like, they probably take half the time that you get in a Western country to finish these ones. So, of the stuff that's under construction, do I think they're going to be still building that for the next 9 years? No. There's a lot of stuff in there that'll just never get built, and it just hasn't been owned up to yet. So, yeah. So the macro. So the net effect is: do we know what's going on? No, we don't. Do I think these lines are at least in some way instructive about the direction? Yeah, I do. I think there's the fact that it's down 50% for starts or more. I think that's directionally right. But the actual numbers, God knows what they really are.
Yeah. So it's certainly quite a confusing picture. But the implications for Australia are worth thinking about briefly, right? So the latest trade numbers came out, and basically the current account surplus narrowed to 7.7 billion. This is based on the data that came out today. But I thought this chart was the most interesting, which was effectively showing that really since June 15, there hasn't been much growth in terms of the metal ores, and more recently, even some of the other commodities are also going sideways. And so, bearing in mind that this is before the China conundrum, so I guess my question is, to what extent do these actually portend as significant concerns for the Australian economy? Because we're so reliant on what happens with China.
Yeah, this is the part I look. I'm a bear on the whole resources side, but for this reason. But I don't know what the timing is going to be on it. And I'll tell you what the nuances that I'm sort of thinking about is. First of all, the world could produce 90% of what it's currently producing in terms of steel and everything like that, and iron ore prices could be at least half what they are now, probably more, probably down 60%, and the companies would be profitable. They'd keep doing it. They'd keep, nobody's going to stop. Sorry, not nobody. We'd only knock out, a very small amount of producers by doing that. And I think as well, there'll be producers in places like China and other places where they'll, even if they are unprofitable, they're going to keep doing it because there are genuine security issues about saying, well, I don't want to, particularly if you're China and you at least, and something might happen with Taiwan at some point, is you don't want to be reliant upon, Australia for all your iron ore to build your battleships and your tanks. So I do think there's in terms of iron ore, the price could fall a long way, and would be perfectly normal. in terms of the stats, so this is the part I just don't know. I do think what's going to happen is I do think they're all utilities now, and I do think they're going to tail off. Like there's effectively government-run businesses are they're not going to be, expanding and trying to build these things as fast as possible. The people who are employed there, as they're seeing these things fall over, they're going to be like, well, I want to build these things and keep my job, but I don't want to build them so fast that I'm looking for a new job next week. So yeah, I do think that's going to take a while. Is it going to be 5 years or is it going to be 2 years? I don't know. Like it's not 9 years. 9 years is, if you read off the official stats, it's 9 years worth of building they can get going without, they can not start another new project and they can still be going 9 years later. That's not right. So how fast it tail off? I mean, probably in any other country, I'd say we're already here, Martin. We've seen shadow banks falling over. That's like the start of the Lehman crisis and the CDO funds, and this whole thing's a house of cards and it's all going to fall over. The question now is, how much does the Chinese government want to, how much are they going to push it, stimulus through to try and keep this thing alive? I don't think they can get it back to the old levels. I think that would require the biggest stimulus ever, like in the history of the world. And for a country that's already spending more than any country's ever spent on that building. So I don't think they can get it back there, but I do think they can try and spend a lot on trying to make sure that, it's a relatively slow descent. And it's basically, the things we saw from China, so the things we saw from Japan, but just way worse on a much bigger scale. I think that's my base case. Do I think it could get out of control? Yeah, it could get out of control. I don't think it's on my base case, but certainly the stats we've seen coming out of the last month have sort of made me more concerned about the bearish case. Yeah. But the iron ore price is going the other way. The iron ore price said, no, it's all back on. Yeah.
So I guess the broader question then is, with China effectively coming off the boil and their stimulus being relatively underwhelming, you've got a strong US.
Well, and also when you say underwhelming, there's a record amount of infrastructure spending going on already.
Yes.
And so I guess that's what I'm saying is they've already turned the dial up to 11, and then they're like saying, well, what more can you do on the infrastructure? There's really not that much more. And actually, I had just an interesting chart. This is one that popped up from the Wall Street Journal. One of these. There's a province called I'm going to butcher the pronunciation, Guizhou, maybe. It's basically one of the poorest states in China, and is literally building bridges to nowhere. It has the tallest bridge in the world. I think it's got 22 or 23 of the tallest 100 bridges in the world. And their exports are basically rice, from this. It's not a wealthy province at all. And that line you can see is going exponential. That sort of in the last, in 2006, when China had already done quite a lot of development by then. This place had a little over 600 bridges. Well, they built another 600 bridges just in the last 3 years. Like it's literally building bridges to nowhere. And so that infrastructure side is there's only so much you can do. Like, is this province now richer that it has 1,800 bridges rather than 1,600 bridges? And I would guess very, very marginally. And they certainly have a massive debt problem and a massive bridge building company that's going bust and employees being laid off and all this stuff like that going on. I think that's just a microcosm of what's happening elsewhere. Is they're building airports that they've have an existing airport that's only 50% used and they're building another one. They've got railroads that are 70% used and they're doubling the size of them. And so I just think they've already turned it up to 11. I don't know if there's much more they can do on the infrastructure side. Sorry, that was a long.
No.
That's in terms of interruption.
Very helpful. But what I was trying to do, I was trying to stand back a little bit and thinking about the US versus China. Like I said at the start, history has played out differently from what people expected. In the US, the central bank is holding interest rates quite high and probably will for some time. They are still doing their quantitative tightening, but on the other hand, the Treasury in the US is issuing a huge amount of bonds. And to my mind, what's happening is that as the Fed turns the dial back, effectively those investors with funds around the world is all being sucked into the US, right? So we've actually got the situation where more and more of the global economy is being sucked back into the US to be able to support what's going on there. And I just wonder what that is doing in terms of the global distortions against, of course, things like BRICS, which are now talking about a multipolar rather than a bipolar world and those sorts of things. I mean, there seem to be some really big international financial forces here which are really distorting markets, and explains partly why it is that the US investment story is so bullish at the moment. But I wonder whether that really is sustainable.
Yeah, in the end, it comes back to earnings for me. And the last reporting season came in at -6 or something, -7%. The current quarter we're in is still forecast to be 0, which is, I guess, not a bad outcome given the second quarter was. I'd be expecting that to come down a bit more. But the interesting thing is still the fourth quarter, which kicks off in. Sorry, we're already into the fourth quarter? No, October when it's going to start. So it kicks off in whatever it is, 26 days or something, is expected to be 8% growth over the prior year. And I don't know, I'm still trying to work out where it's from. So that's the key part. I do think there's downgrades to come. And if we're on pricing of, if you exclude resources and banks to sort of get a more normal picture, we're on 20 times earnings. Like it's that basically the only other times we've been this high is when there's this massive growth cycles going on, and I can't see what the growth cycle is. I could be wrong, but I have 3 big growth cycles. We'll probably run out of time for this, but we should talk next time. I've got 3 big growth cycles on stocks that I'm interested in over the next decade. But and let me touch on them really quickly, and then maybe next time around we can dig it a little bit more. Is that there's obviously the AI, and that's sort of but I'm less interested in the companies producing the AI, and I'm more interested in what sectors are actually really going to benefit and not benefit. And so it might be along the lines of looking at companies where or sectors where like healthcare is a good example of research where, okay, you've got a lot of smart people there that actually aren't computer scientists or don't know how to program and things like that. And now they have tools that actually would make a lot of the AI testing and statistical work that they might want to do a lot easier. So I do think there's parts there. We were big investors in the obesity drugs, which has sort of been a bit of a win over the last month or so, where some of the basically they were creating these drugs for diabetes and really helping on sort of Eli Lilly and Novo Nordisk. Very helpful for diabetes, but most of it seems to be a weight loss. So basically, it's largely an appetite suppressant, and it ends up in the people. If you've got diabetes and next thing you lose 10, 15 kilos, your diabetes gets a lot better. And now they're applying it to everything. So we saw some big downgrades from ResMed, some big share price falls from ResMed, which is in a sort of similar spot. ResMed themselves are like, no, people will keep buying our things, but they're basically running these tests now to say, well, okay, well, if you give people this drug and they lose 15 kilos, then actually maybe ResMed loses a big chunk of their customers. Where else does that have an effect? Fast food. There's does it mean people eating less? If you're running gyms, does it mean that if it's a choice for people between taking drugs or going to the gym, where are they going to sit on that spectrum? There's a whole bunch of factors that, and this is very early days still. I just want to say it's very early days. We haven't got all the results in, but the results so far seem to be really good. Is that if there is a range of drugs out there that could take the most overweight 10-20% of our population and shift them down 10 or 20 kilos, that would make a huge difference to our healthcare system. Food, gyms, anyway, some big things going on there. And the last one is driverless cars, where I've spoken probably a few times on here. I've certainly been guilty of thinking they're coming sooner than and me and a lot and the car companies themselves, I guess, are coming sooner than they have. But they are live testing they're running live driverless taxi trials. They've been running in Phoenix for some time, and they went live in San Francisco with Google and Cruise, which is another part of a large car company, and it looks like it might be here. And if there's something where again you took the least used 30% of cars in the world and got rid of them and replaced it with robo taxis, that would make a massive difference for many people. And if you think about your average Uber trip, more than half of your cost is on the driver. And so if there's no driver, and you have to pay half as much, then all of a sudden, a lot of these come back to much closer to public transport prices. And so a whole range of different effects that could have. And so that's sort of my three big trends that over the next decade, I can really see some growth. Are they enough to justify paying 20 times or 21 times for the market at the moment? Not in my mind, but it's certainly some trends we should be following and looking. Where can we pick up stocks or certainly if we get any weakness and these higher interest rates do sort of end up in an economic downturn. You want to know now where you're going to be looking for stocks at that point, for the stocks that are going to carry you through the next cycle.
Yeah, thank you very much, Damien. And there was one last question which Electro Fry bowled in to say, given the 4.1% today from the RBA, because they held rates, do we expect the first rate cut in 24? Maybe it could be even later than that, according to some of the data I've looked at. Are the banks in trouble? Two quick responses from me on that. One is sort of yes and sort of no, because they've still got quite a lot of margin they can play with, internationally speaking, compared with Australia. The banks here in Australia are doing quite well from a margin perspective. And two, the big ones will be propped up by the government anyway. So they are as sure a bet as you can get that the government will save them. So my view is it's not huge.
Yeah. If our government is willing to help Qantas out, will they be willing to help the banks out? I think the answer is very much yes. And that's the thing for people who worry to come to me and say, look, they're really worried. Money in the bank will, what would happen if this happened and property crash, and will the banks fall over and stuff like that? And I say, look, it's always possible, but if you're a political party who voted not to bail out our largest banks and all their customers, that'd be the last time you're in power for a generation or two. So I think Australian politicians seem to be quite happy to stand behind some of these companies, and that's arguably why the Australian banks are basically some of the most expensive banks in the world. But arguably, it's because they've got a government that's as behind them as anyone. You look at all the US banks, for example, and there's literally thousands of them there, and they're certainly willing to let some of the smaller ones fall over. Whereas that really doesn't seem to be the case in Australia.
No, it's a different rule set. Interestingly, I some time ago used to have NAB shares, and I sold them some time ago when I decided they weren't ever going to hit above 30. Guess where they are now? Still below 30. Tells you something important, I think.
Yes. But on the flip side, they are paying a good yield. So
absolutely right.
Another price.
Yeah, exactly right. It goes right back to what we were saying earlier on. Damien, I want to say thank you very much. We've covered a lot of ground tonight, and very important conversations there. Links and things below if people want to find out more about what the world funds and Nucleus Wealth. And I look forward to catching up next month and exploring those three themes in a bit more detail, because I think we could probably do a whole show, frankly, on just those three themes. Yeah, absolutely. Wonderful. Thank you very much. Appreciate that. I'm going to take you off air now, and I'm just going to close the show. So thanks, Damien. Okay, there you go, folks. I hope you enjoyed that. Thank you for all the questions and comments. I was following along best I could. And just to say that next week I will be on without a guest because I want to go through the latest household financial stress modelling and analysis. The truth is that the data is looking pretty sick. I did do a flash post on X or Twitter the other day, and I want to go into that in more detail, so I'm going to be covering that next week. I'll have the postcode engine online there as well. So I look forward to seeing you there, and obviously catch up with my other shows as I release my daily shows. And thanks very much for spending some time with us this evening. Have a good evening, and look forward to seeing you next time. This is Martin North from Digital Finance Analytics, signing off. Cheerio.